I think people who invested in this space, looking at past returns and expected quick returns, have been disappointed very clearly. But that was probably not the right way to look at this space. If we look at the underlying trends, which have been playing out for a very long time and which are expected to play out over the next decade as well, in my opinion, those are intact. So if we look at the habits of people or the trend shifts, people are preferring streaming media content versus linear TV. People are preferring e-commerce versus physical retail. People are going towards cloud computing instead of on-premise servers. Digital advertising is the preferred medium over traditional advertising. So I don't think there's anything wrong with the underlying trends that have played out in the past and that are continuing to play out in the future. Sure, stock prices have come down a bit. There is increased focus on profitability. There is focus on cost controls and things like that. And some of the side projects have not been looked at kindly by the markets. But these are very, very strong companies. Most of them are either monopolies or duopolies in their area of operation. And the valuations are not demanding at all. So these are somewhere around 20 times earnings, or in some cases barely double-digit price to earning multiples. So it's not that these are very expensive or these are zero growth companies or anything like that. So we are quite positive on this space going forward as well.
But what about locally, Rajeev? Because you spoke about these digital trends. They are true of India as well as they are of the US. But here, investors seem to have given a very wide berth to these digital stocks, and there is, I mean, you know the Zomatos and even the Nykas of the world these days. As a fund manager, how have you looked at Indian digital stocks compared to the US ones?
Sure, Udayan. So that's a very interesting point that you're making, and I would like to differentiate the tech space into two buckets. In one bucket, I would put companies where people see a future promise in terms of growing market share or lifetime value of a customer, but current reported earnings are either in losses or barely break even, and sales growth is typically higher. So in this space, to an extent, there is a dependence on raising fresh capital from investors, either in the private space or in the public listed markets. And that funding environment has gotten very tough over the last year or so. And this will be a moment of truth in the coming year or so, where these companies will have to quickly pivot towards showing profitability, or at least eliminating cash burn and having clarity on the path to profitability. The space where we are invested in are, I would call, somewhat mature tech space, where they have been around for a couple of decades or more, where you can value them on a conventional basis in terms of the cash flows that they are generating or in terms of the revenue that they have and things like that. So I think the companies that we own, which are the Microsoft, Alphabet, Facebooks of the world, are very, very different from, let's say, a Zomato or from a Nykaa. You have these kind of companies in the US as well. So you have things like DoorDash, etc. in the US, or Grubhub and those kind of companies. But we have stayed away from loss-making companies or companies which have a lot of cash burn, because we are not clear on what the future will look like. We are more positioned towards slightly more mature businesses.
If you like the video, do like, comment, share and subscribe.